Fantastic. Thanks so much, Christy. So as Christy mentioned, my name is Joy Fisher. I do have the privilege of being a member of the Flywheel Winston-Salem location. And I am actually not a small business or entrepreneur, nor am I innovative enough to do what you guys do. I work with Clifton Larson Allen. We're known as CLA, and we're the 8th largest professional accounting firm in the nation. And we do much more than just accounting. We are audit, assurance, tax, wealth advisory, and a plethora of different consulting and outsourcing services. Everything from if you need interim assistance, if accounting type assistance, payroll type assistance, project type work, and we have a breadth of different service lines, everything from forensics to data security to cyber security. And we just love at CLA, we have offices across the nation, over 120 offices, and really our pride, our joy is CLA exists to create opportunities for our clients, for our communities, for our CLA family members. Our goal is just to help serve and plug in those roles wherever we can. Within North Carolina specifically, we've got offices in both Raleigh and Charlotte, and our presenters today are from our Charlotte office. But the reason that I and a couple of my colleagues are members of Flywheel is because I'm located right here in Greensboro, and I'm not going to drive to Charlotte or Raleigh every day. And so I needed a place very similar to Flywheel so that I could come in, network with you guys, get some work done. And as a couple of us were joking about at the beginning of the call, be able to be in presentations and professional meetings without my children and my dogs running around in the background. So we joined Flywheel even pre-COVID and pre-pandemic because we really needed this professional place to come. And I'm actually here in Flywheel today, in fact. And so with that, Christy did reach out to me knowing that CLA is one of the largest professional services firms in the nation, and would we be interested in speaking with you all today on tax? And the number one best thing I know about taxes is that I should not touch them with a 10-foot pole. And so what I told Christy is absolutely CLA has that depth and that experience, but it does not lie with me. I'm in our consulting practice. I do have the privilege of overseeing a national team of project leaders and technical advisors that assist our consulting group, as well as oversee some of the quality and security within our consulting group, but I do not have any business doing taxes. And so with that, I would like to take a quick moment to introduce our two speakers today. We have joining us Wendy Body. She is located in our CLA Charlotte office, and Wendy is actually the managing principal of our Charlotte office. And prior to that, she's even served as the tax principal in charge for our CLA Carolinas practice. And with almost 20 years of experience dealing in compliance issues, tax issues, individual, publicly, commercial businesses, various number of industries. Wendy has about seen it all at this point. Sorry, Wendy, I'm dating us a little bit, aren't I? And so Wendy's about seen it all at this point. And so we're very, very fortunate to have her joining us today to talk with us all about tax planning. In addition to that, I know one thing that I found very helpful is when I'm looking at tax tips, it's not just about current year and what do I need to do. It's also about tax planning for looking forward and retirement planning and making sure that myself and my business and my children are set up for the future. And so with that, we work very seamlessly throughout the different service lines within CLA. And we have Steve Powers joining us as a co-presenter today as well. Steve is a senior wealth advisor within CLA's Wealth Advisory Group. He joined the CLA family just over a year ago. And he brings premier wealth management experience and wealth advisory experience to the table, and you'll hear more about it today. But Steve works very closely with Wendy and her team to make sure that we are providing our clients that full service picture of anything that we can do to help serve them and help provide you those tips, not only after you're up and running, but I believe maybe it was Gilda who said that you're looking at potentially starting a business. So we're excited to serve here as a resource for you today. And with that, Wendy, I'll turn it over to you.
Well, thank you, Joy. I feel like maybe you built me up a little bit too much there, right? I might not be able to answer one of your all's questions, and then I'm going to be like, oh man, Joy built me up like I can tackle any tax issue that comes down the pike. But I think the important thing to know as we get into this conversation, and I am very comfortable with this being a conversation. As Christy said, if you want to interrupt with a question, drop it in the chat. I'm happy to go there with you. Tax changes all the time. The one thing in the tax profession that we always say is if you're not a lifetime learner, this isn't the work for you. I have been doing this for 20 years, but you know, a couple years ago, we turned the entire tax code on its head a little bit, and we've had 2 new bills in 2020. So it is constantly changing, and I'm hoping that I can share some of those changes with you to have you knowing what to look out for in the changes. Maybe you've been doing your business taxes for a little bit and know what was out there, but there's some changes coming and you want to hear about those. But I'm also going to hit on some of the most frequently asked questions that I have from small businesses and entrepreneurs, so that, you know, things that have been around a while, maybe you haven't had an opportunity to iron out all the details of. So we'll touch on those. And then a couple times there, I'm going to have Steve jump in and talk with me about how there are lots of opportunities to combine tax benefits with putting away money for yourself or your family instead of giving it to the IRS, right? So, or the North Carolina Department of Revenue. So I am going to share some slides. I do have a few slides prepared, but please, as we go along, or if we get to the end and I haven't touched on what you want to talk about, like a lot of you said structuring, I don't have any structuring in the slides. Feel free to ask a question. We can talk about that. So I am good at tax and not great at technology. Let me figure out my share screen here. Okay. Can you see me?
We can,
yes,
Wendy.
you're all good, Wendy.
Look good.
Great, great, great. All right, so as I said, what are we going to talk about today? What's for breakfast? What are we chewing on for this next hour? Well, we're going to talk about the 2020 business tax prep, because that's where we are. That right now, we are talking about 2020 business tax prep, some pitfalls, some opportunities, some changes. You may have heard that potentially the deadline would move. We've got all these lobbying organizations out there trying to get that move that we got last year. As recently as yesterday at the Federal Bar Association meeting, the IRS commissioner said, nope, not moving that deadline. So the time is now. We've got March 15th deadlines if you're an S Corp or a partnership, and then of course your 4/15 deadline for the individuals with a Schedule C. And then we're going to talk a little bit about 2021 and beyond, because the best time to do your tax planning is as you're making those business decisions, not necessarily after the year when you're filing. We are going to have a couple opportunities for you for 2020, but right now, start thinking about 21. And then, as Joy mentioned, retirement planning is tax planning, and there are several other opportunities where you can do some financial planning, and that will be tax planning. And then I'm going to serve up some 1040 tips for dessert, because we're talking about businesses, small businesses and entrepreneurs, but you cannot do a business return for an entrepreneur without thinking about the 1040. You have to holistically tackle the tax for both the individual and the business when we're talking entrepreneurs. So let's start with the most common questions that I get from my small business clients: the Schedule Cs, the 1120S with an owner or two, or a partnership, a 1065. And the first one is vehicle expense. It is one of the most common deductions taken by entrepreneurs. You use your car to visit clients, customers, prospects, to come to your flywheel office, or to travel around the region if your clients are around the region. There are a couple different ways that as an entrepreneur you can take a vehicle expense. The first one is if you have a personal auto, an auto not owned by your business that you use for business, you can take a standard mileage with a contemporaneously kept log. So that's a big word that says every day when you're driving, you must write down the mileage. You can't go back at the end of the year and be like, oh, well, you know, I think I did 30% and I did 60,000 miles, so maybe 18,000 miles. If you're brought under examination by the IRS, you have to produce the log that you use to keep up with your business trips. So that is the first way that you would take a deduction on your Schedule C or on your return, is you would take the number of miles you drove, business miles for the year, multiply it by 57.5 cents for 2020, 56 cents for 21, get a number and take it as a deduction. Very simple. A lot of people use that method. Other than keeping up with your log, it is the easier way to go. But then there's the opportunity for your business to actually own a vehicle. And maybe you have a business vehicle with some personal use, different than the personal use vehicle with some business use. And why might that be important? So this is one of the reasons why. If you have a business vehicle that you have on your balance sheet in your business, you're actually going to take the depreciation on that vehicle. You're going to take the actual maintenance expenses, the oil, the gas, the tires, all of those actual expenses. But that depreciation is the one that sometimes gets a lot of press, right? Because if you happen to go to a car dealership and mention that you are a business owner, all of a sudden your car salesman becomes a tax professional and tells you that you can write off your car. And there is some truth to that, but I'm always like, oh, please don't take your tax advice from the car salesman. He's great at selling the cars, but there are some caveats to that with the depreciation. So let's talk just a little bit about what those are, because you may say, I really want to write off my entire car. Okay, I would want to do that too. If you are solidly 50% or more business use, then you might want to look at the actual expense method of your vehicles, because the depreciation can be such a large write-off. But if you are not solidly over 50% business use every year, there's a gotcha in your depreciation, which is the year that you drop below 50% business use, you have to recapture all of that depreciation of your vehicle and pull it back into income. So, you know, that's why we recommend, if you are wanting to do the depreciation methods, that you are solidly over 50% business use and can document that. The one thing that the car salesman is telling you is you can 100% write off the cost of your vehicle. And there is some truth to that. So the methods are 168, code section 168, bonus depreciation. You hear that referred to as the bonus depreciation, or the section 179 deduction. And basically, if you buy a luxury vehicle, if you go out and buy a BMW sedan, you're not going to get the opportunity to write off the entire amount of the depreciation. The IRS puts some stopgap in there, right? Some control over the fact that you have to be limited in the luxury vehicle deduction. The 2020 cap for the luxury vehicles is $10,100 of first-year depreciation plus another $8,000 of bonus depreciation. So you can take $18,100 on those cars. But there is an exception if you have an SUV greater than 6,000 pounds, and I'm not exactly sure why this is the particular limit, but if you have an SUV greater than 6,000 pounds, you have no limits. So you can actually take that entire deduction as 168 bonus. So there is some opportunity there for you to potentially 100% write off your vehicle. And so the next time you're in the car dealership and the salesman is teaching you the tax, maybe you can set them straight and give them some of the details about when you do and do not get to do that. So now the next thing we're going to talk about is home office. So these couple things are the ones that I get questions all the time about. Home office, again, there are two ways that you can take the deduction for a home office. The first is what's called a simplified computation method. The IRS brought this out, I want to say it was 2013 2013, 2014. So some of you may be familiar with this as individuals who might have your primary office. I heard a couple of you in the introductions talk about being at your home office, the dogs, the kids. So they came out with this simplified method to make it easier for those that want to take a home office deduction to not have such voluminous record keeping to take that deduction. So the simplified computation method is if you have a home office that is dedicated to business. So it can't be home office and the kids' video game, home office and all our gym equipment, home office and, I don't know what else, guest room. You can use that space up to 300 square feet times $5. So you can get up to 1,500 of a deduction. And that's as difficult as it gets. It's for self-prepared people who do their returns themselves. It is a great method to use. So you take the square footage times $5 up to 1,500 with the limitation that you have to have income. So you can't put yourself into a loss position with the simplified computation method. The second method is more complicated to keep and frankly was abused a good bit. So the IRS actually was looking at these computations for many years because this was abused so much. But what the actual home office deduction says is take the square footage of your office and take every expense associated with maintaining your home. All of your utilities, your mortgage interest, your pest control, your lawn service, I mean, absolutely everything that is associated with maintaining your home, take the square footage of your home office over the square footage of your home, get a percentage and multiply it by all of those costs. So you can see where there was the ability for there to be a lot of abuse there. Again, it has to be 100% dedicated business space. So that is the more complicated method, but if it gets you a significant amount more and you have that dedicated space, you should go for it. All right, the last one is meals and entertainment. And I think this has become such a question over the last couple of years because it changed, and anytime there's change, there are a lot of the taxpayers who are still thinking about old rules like 50% of meals and entertainment. And then the change comes, and when we get to the tax preparation, I'm like, okay, so what was this at a sporting event? And they're like, well, I had a box seat and I took clients and entertained them. All right, well, that becomes entertainment. And the Tax Cuts and Jobs Act, which was passed in 2017, most of it went effect in 2018, took entertainment to 0% deductibility and left your meals at 50%. If you don't have the ability to separate the meals from entertainment, so I mentioned the sporting event, some boxes don't give you a broken out bill with the meal and the entertainment portion of your box, well, then it becomes 0%. So as often as possible, you want your meal and entertainment to be separated so that you can get to the 50% deduction. Now, meals and entertainment is going to come up again when we talk about 21, because there was recently a change for 21. So again, one of these things that changes often. So, all right, so there are some.
Wendy,
Steve,
can I jump in real quick and
absolutely
go back, if you will, to the home office deductions there? One of the common things I've heard over time is that's one of those red flags type of thing. And I think you addressed it with some of the abuses. Should there be concerns along those lines?
So I will say that anything that that you can support, you should not feel shy about taking, because I have clients who legitimately have a room over their garage that is their dedicated office space. It's the only place they ever work. And they're like, we'll just do the simplified method because I'm scared of the IRS. Okay, if you legitimately can take that deduction, then I would say go ahead and do it. Is it something that is more observed or looked into by the IRS? I would say that is probably an accurate statement. But if you're not in an abuse situation, then you don't have to be scared of the IRS. We've gone through so many different periods with the service, right? Where the bad service, the working with you service, we go up and down, we go through trends. But my experience through many examinations with SBSE, which is Small Business Self-Employed Examiners, because that is the primary base in my clients, is that they are very reasonable when you have legitimate documentation for your deduction.
Okay, thank you.
Mm-hmm. All right, so you're getting ready to prepare your 2020 return, and a lot of small businesses are cash basis, which means once that midnight bell tolls, the ball drops on the new year, you've lost out on a lot of your tax planning opportunity. But there are still a few things that you can look at. And this first point I want to throw out there, because a lot of people through COVID in 2020 ended up in a loss position for that year. And so they're like, okay, well, great. I'm glad you're giving me the tips, but I don't need deductions. Well, one of the things that came out of the Coronavirus Aid Relief Economic Security, the CARES Act, everybody refers to it as the CARES Act. One of the things that came out of that is the fact that you can take a net operating loss and carry it back 5 years. And so if you had a great year back in, 17, 18, one of those, you can carry back your 2020 loss and generate immediate cash flow. And the great thing about this, if you stop and think about it, for those of you who've been doing your taxes for a few years, the 2016, 2017, those rates the tax brackets were higher. So we're not even talking a timing difference of carrying forward versus carrying back. We're talking a permanent difference in tax rate. So you may want to gather those deductions, even if you're already in a loss position, so that you can do a carry back of your loss. So that's one thing to think about when you're working through this prep. There's a couple of other things that can help with capital gains. Qualified opportunity zone, if you had a capital gain, even all the way back in late 2019, there's opportunity for amendment, and self-employed pension plans for individuals on a Schedule C or partnerships. There's still opportunity to make contributions and deduct in 2020. And I'm going to ask Steve to hop in here with me and talk through these, because these really do give you that financial planning aspect with your tax planning. So Steve, I think you want me to pop over to this next slide?
Well, we'll stay here for just a second,
Okay.
and you can go forward to that one there. But and certainly, good morning, everyone. Thank you for having us and setting this up, and wonderful just kind of to hear the different stories and the like, and certainly excited to serve you there. But as Wendy alluded to, one of the greatest tax benefits that came out of the Tax Cut and Jobs Act in 2017, particularly from the investment angle, was this qualified opportunity zones there. And as a result of COVID and some extensions that we've had, we still have some tax planning opportunities from 2019, even late part of 2019, and all the way through 2020. And so let me step back for a second. For some you'll know what I'm talking about. For some, this might be an introduction. So here's what happened in the Tax Cut and Jobs Act, and here's how it applies. They wanted to create public-private partnerships there and help some underprivileged areas with new capital and development there. And this is one of those few actual bipartisan things. Those actually do exist from time to time in Washington, D.C. This was one of those bipartisan deals, so we feel confident that it'll survive through administration changes. But what it said was each governor identified certain areas in their states. About 87,000 different zones, opportunity zones, were identified, different census tracts. We've got a map on our website. You can identify where those are, and I'll talk about that in a second here. But what it allows you to do is to receive three really important and pretty significant tax benefits. So if you've got a gain from anything, and that could be capital, that could be real estate, that could be selling a business, that could be stocks. And so a lot of people had those last year when they sold from COVID or got worried about the markets there, where you sold a business and like, if you did that, you can take that gain. It doesn't have to be the gain and the basis, like a 1031 exchange, if you're familiar with that from selling a real estate property. Just the gain. You can roll that into and reinvest that into one of these qualified opportunity zones. So it's got to be in that geography there that we talk about. And here are the three key benefits that you get out of this. And I'll talk about a couple of the folks that are starting up business here in a second there. First, you get to defer that gain. So you recognize the gain in late 2019 or any time in 2020. Well, Uncle Sam normally wants his money and they want it now. Well, you can delay that really about 6 more years or so and tell Uncle Sam, hold off, we'll pay you in 2000, I think it's 26 or 2027 when you actually have to stroke the check. So you get to keep the money for much, much longer. You actually get to reduce that gain. The second benefit is you actually get to reduce that gain. So if you had, let's say, $100,000 gain for round numbers there that you would normally write on your taxes for this year, that gain that you will pay taxes on is reduced by 10%. So you actually probably likely pay Uncle Sam not only down the road, but maybe a smaller amount there as well. And here's the key benefit for the next thing. Because they want this public partnership, they want you to reinvest in these areas there. And these areas aren't all blighted areas. These are attractive areas in many cases. When you reinvest and hold into real estate or a business or other things and hold for 10 years or more, the gain on that reinvestment, that new investment, is capital gains free when you go to sell that in 10 years or later. So three really key benefits there that are appropriate. One is you get to defer the gains. Instead of writing the check now, you get to do that and save that money for a number of years and hold on to that and reinvest and do other things. That gain is actually reduced to a small degree there and saving you future tax dollars as well. And then when you reinvest, that could be really attractive because now the gain is completely capital gains free. So coming to this group, one of the things I heard a number of folks talk about was starting up a new business. Gilda specifically talked about it. We had a new business for a fabric store there. If you were, for instance, to set up that business, you'd want to do it in the right area, but let's say there was an opportunity zone and you had a choice between setting up the business on one side of the street or on the other side of the street in the qualified opportunity zone. That business thrives, succeeds, and you go to sell that in 10 years, you could sell that business capital gains free. Now let's get a windy body involved in making those decisions. But for you with some flexibility, it could be a really attractive way. And again, for anybody that sold stocks, sold a business or other things that like that in 2019, late in 2019, and you can go back and amend returns, or 2020, great opportunity to shelter, reduce, and then reinvest those gains and have opportunities for capital gains, free treatment down the road. So one of the most powerful tax treatments we've seen in a long time.
Steve, I've got a question on that.
Sure.
With OZs, you can invest into other early stage companies, right? So if there's a startup that is working in Flywheel, which is in an opportunity zone, if I had capital gains, I could purchase equity in that company. And then does that company have to stay in an opportunity zone for the length of the investment until the acquisition or sale of the company? How does that work?
That's a great question. I'm not sure if because I haven't addressed if there's a move or anything. I think and Wendy, jump in, correct me if I'm wrong here. I think it ties to where your primary business is. The primary business has to be in that opportunity zone. So I don't think
Absolutely, and you have to have a spend. So a business, a QOZB, a Qualified Opportunity Zone business, actually has to go through testing about the amount that they're spending in the zone. They have to stay in the zone for you to continue to have that that deferral, and they have to have investments in that zone, either in employment, in assets, that type of thing. So there are some certification processes. It's not as simple as saying my zip code dedicates me as a qualified opportunity zone, so now I'm deferred. The qualified opportunity zone business needs to be in a qualified opportunity zone fund. Woo, there's a lot of qualified opportunity zones, and then you have to pass testing. So there are some hurdles to get over for the business and the fund itself, but the fund is usually a partnership that then you can make that investment into. And what we see is that if a business is going to leave the zone, the opportunity fund actually has the opportunity to then move that investment to another business in the fund so that they stay in the opportunity zone, so that you can still be deferred as an investor at the fund level. Does that make sense?
Yeah, it seems like a little bit extra administrative burden on the fund manager, and you get less of the portfolio benefit as well.
Yeah, there definitely is some benefit to the fund manager, and I think Steve would agree with me here that we have advised clients who like this strategy that you do not look for a new to funds fund manager. So if you are interested in going into a qualified opportunity zone fund, we would be looking for that to be with a company that has had real estate funds that have a proven return record. We don't let the tax tail wag the dog, right? We're not just looking for tax deferral. You need tax deferral with a strong return. So we want proven track records and fund managers that can generate proven results.
Yeah, I've seen mostly it's been in real estate,
Yep.
but I know that it does allow for this fairly startup investment. Have you all seen many OZ funds going the equity investment route?
So I will tell you that what I have seen has been a lot in the tech space with individuals who, tech companies, a lot of their employees are dispersed into their homes, into Flywheel, into, these types of places, but they have a headquarters that they can put in an opportunity zone, an area that maybe used to be depressed and is up and coming. We have several of those around the city here in Charlotte. I'm sure Winston-Salem and Greensboro have the same type of thing. And we have the companies coming. Steve mentioned this. We have the companies coming saying, I'm going to start a new company, and the idea of my tech company ramping up really quickly and being in an opportunity zone fund where then I do not recognize gain on the sale. So that is more what we're seeing from the entrepreneurial side. The funds themselves, as far as investments, are pretty much real estate. I've seen here in Charlotte, we have a company that does municipal properties. So a little bit lower return, but guaranteed. If a city parking garage or a wastewater plant is in the opportunity zone and you get it in that fund, that city isn't going to tank like a commercial real estate might, right? So you get a little bit more guaranteed return. So you're right, a lot more of that real estate type play in the investment, but we are seeing some entrepreneurs start businesses in the QOZs.
Thank you.
Yeah, and just elaborating exactly what Wendy said there, there's the entrepreneurial spirit that wants to go in. I see in the chat that Flywheel is in an opportunity zone. Exactly. So that spirit there, again, more complexity. Really, this is not a quicken, software H&R Block kind of thing. You want to make sure you got Wendy on your side there or somebody else like that to make sure. But yeah, there's lots of tech entrepreneurs that see explosive potential growth in their business, and so they want to be in that space. For a little more passive type of thing, the real estate has been the other key dominant driver there. Investing with as Wendy said, qualified opportunity zone fund managers who are taking the gains and investing in real estate, commercial, hotels, office, a lot of last mile industrial, so Amazon warehouses and things like that. And those in particular, for more so the passive type of investors, are attractive because they know full well that you're going to need some tax monies to pay Uncle Sam in 2026 kind of time frame. So they're able to create some distributions in that time frame for you to pay off your tax bill there. So it's a really powerful tool. Look into it aggressively there for entrepreneurial, or you've got gains, particularly if you had them in 19 or 20. But there are some complexities to it. It's not easy, and the IRS doesn't want you to abuse it there. But it's a wonderful tool. So shifting gears, Wendy, we'll jump to the next screen here and try to pick up the pace a little bit from my standpoint there. Here's what I heard. So I'm gonna speed this up a little bit there to save more time for Wendy there. But retirement plans are just one of the most easiest ways for most people to save money, save taxes, grow your business potentially there. I'm going to focus more so because I heard a lot more independent contractors, self-employed folks versus maybe the 401k. If you want to talk about those things, we can certainly do that. But even if there's two things: the SEP IRA, the traditional IRA, and maybe even the self-employed 401k and cash balance plans are the ones we'll just hit really quickly there. The SEP tends to be the deferred vehicle. A couple of things on that's really attractive. That's one of the few vehicles at this point in time that you could go back to and start up a brand new plan, help you shelter maybe upwards of 60,000 in range, depending on your age and the like, pre-tax monies from your 2020 bills. Most of these plans require you to set them up in the year you're going to contribute. So if you don't already have a plan, and we're now in 2021, well, you can't use one. SEP allows you to go backwards and shelter monies in there. It's fairly simple, pretty easy to do, and like the one hitch sometimes in the giddy up there, but really didn't apply to the folks that identified themselves today. As you get employees, you generally, there's some exceptions, as there are to everything. You generally have to take care of all your employees that are eligible, and that's a really big key word that's important here. Eligible, what you do for yourself, you have to do for them. But for the self-employed individual, that's one of the best tools that are out there. One of the things not to overlook, though, is the second one there is IRAs and spousal IRAs. If your spouse doesn't work and you do, those are easy. Most people tend to forget them because they're small, 6,000 or 7,000, but they're easy ways to do. And some of those, depending on your situation, might be tax deductible for you as well. The self-employed 401k is kind of skipping to the bottom half of that section. That's a lot like a SEP IRA. Important differences, but for that self-employed individual, there's two ways you get money into that. So some people are able to get to the full maximization earlier with that one there. A little more complexity, a little more paperwork, a little more cost than the SEP IRA there. But both help that self-employed independent contractor really salt away a good amount of money. And then, for many of is going to be a smaller subset, but I heard an attorney on here and others there, professional services. If you've got good success, strong income already, and particularly if you're a solo or a couple of persons involved there, cash balance plans are complex. They can be relatively expensive relative to the other things we talked about, but you can salt away significant 6 figures and more type of income pre-tax through a cash balance plan there. So that's kind of a supercharged SEP IRA, if you want to kind of think about it like that there. That's a gross simplification of it. But what you've got really, as you talk about right now, particularly for these self-employed, the folks on this call here, is with the SEP IRA, the opportunity in particular to go back into your 2020 businesses, set it up now and contribute to it and reduce your tax liability for 2020 and look forward into 2020 and beyond. Potentially the IRA is a simple thing. Don't overlook that one, particularly if you've got a spouse that's not working. You can put monies aside for them there as well. And then we can talk about the other plans that are available to you. But this is a powerful tool to go look backwards, save some money off taxes, and grow your wealth and pay yourself first. You don't want to reinvest. Most people will tell you not reinvest everything back in the business. You certainly want to take some monies out, grow your nest egg outside, and pay yourself first. And the SEP IRA tends to be a great starting point for that conversation. So let me stop and take a break and see if there's any questions before we move forward there. When do you want to go?
Yeah, absolutely. And first of all, I will apologize for the screen thing. I don't usually use Zoom to present. I use Teams, so there might be something still on the screen. We're just going to go with it.
You're good.
I'm trying to make it so I can see the slides, right? All right, so let's talk 2020 tax prep issues that may impact you that you need to have on the radar. So first of all, did you receive PPP funds? If you did, we kind of went through this roller coaster, right, of the federal government saying it's not taxable income. Then they said, okay, but you can't take your deductions associated with the PPP. Oh, and you have to add them back in 2020. Oh, wait, no. Here comes the lawmakers, the legislature, and says you can take your PPP expenses as deductions, but North Carolina has not matched to federal. So as we sit today, there are two bills in the North Carolina legislature that would match federal, but right now you have to make all of your expenses non-deductible for North Carolina purposes. And that is an important thing for you to know, because as business owners, you need to contact your representative and say, this doesn't make any sense. Why, I need to be able to match federal and take my deductions. Did you do employer side deferral of payroll taxes? If you did, you do not get to take that deduction in 2020, even though they were related to payroll in 2020. And then did you receive unemployment or pandemic unemployment? Now self-employed individuals could have that in 2020. That is taxable income to you, so be prepared for that piece. 1065 filers, I didn't hear any multi-member LLCs, which are partnerships, but if you are doing that, there actually is some new tax basis reporting on your 2020 return. So those are a few pitfalls to look for. One thing, when I mentioned the not deducting employer side taxes, that I forgot to mention in the thumbs up, is if you received an SBA 7A 504 or micro loan and got the 6 months of payment where the SBA paid your loan for you for 6 months, you might have been surprised to get an interest statement from the SBA that included the interest that they paid on your behalf. That was a nice little yay. That is 100% deductible for you, even though you didn't make the payment. So we like that one. All right, so now let's move on to 2021 and beyond. The first thing is meals and entertainment. We talked about the fact that that is now 100% deductible under the Consolidated Appropriations Act, which was passed, I believe, December 27th, 28th, somewhere right around there, a little Christmas gift for us, right? 100% provided by a restaurant. And the provided by a restaurant is some interesting terminology, because it means you can carry out, you can have delivered. It was provided by a restaurant. They're trying to spur the spending at the restaurants for 2021 and 2022. So that was a good upside there. And then two things that we've touched a little bit on retirement planning. Steve, if you want to talk more about how you can plan into the future about retirement planning. We didn't touch on HSAs yet. And if you happen to use, a lot of self-employed individuals use the higher deductible plan, because they're covering all that cost themselves, right? And as a smaller business, it's kind of expensive. So they go with the higher deductible plan, but you have a great deferral and saving opportunity with an HSA. You want to chime in on that a little bit, Steve?
Absolutely, absolutely, Wendy. And the HSA is the best savings vehicle that's out there because it has three key benefits to that. And first off, you get to deduct the contribution that you put into the plan, and that's tax deductible. Secondly, that money grows tax deferred, so Uncle Sam isn't touching it. And then thirdly, if you're using it for qualified healthcare expenses, in the future there, it comes out tax-free at that time. No other accounts have or portfolios have all three key tax benefits. Most of them have one or two of those type of accounts there. And if you build up enough in certain memberships or certain providers, you can actually invest that into index funds in the markets, not just cash in there. So check with your plan provider on there. But the advice I try to give to folks is what is something harkens back to me when I was 5 years old, walking through a store with my mom and walking through the area. You can look, but don't touch. I highly encourage you to not touch your HSA if at all possible there because of those three key tax benefits. You get the upfront deduction, but if you can let this grow tax free and come out tax free, excuse me, tax deferred and tax free on the way out, it's a great way to save some additional monies, pay for your healthcare expense out of pocket or even with another FSA that's at use it or lose it there, and just let that $6,000, $7,000 contribution continue to grow almost like another Roth IRA there. You know, if you're not in that position, that's one thing, but if you're in a position where you've got that flexibility, I highly encourage folks to use that like another retirement savings vehicle. Sock that money away, forget it. If you can invest it, fantastic, but it's the best account out there, period. The only problem is it's only limited amount of money that's you can put into it, but definitely take full advantage of that there in there. And to the retirement plan, I think we spent plenty of time on that. But should you have any questions, if you have a plan, ask your provider on a couple of things. And where I tend to find the three topics most people have questions on, concerns, or, and if you've already got a plan, talk with your provider. If you're interested in setting up a plan, you know, we're happy to help you with that as well or answer questions. But the three things people are most concerned about of the five that I focus on is what are the fees? Two, and most people overlook this, but what's your fiduciary role? And that's still important there. And then the one that's fun and exciting to talk about is the plan design. And that's how you customize a plan for your needs and your business's needs there. And many times that's how do I maximize and make sure I get the most money from the business into that plan there, in there. So those are the three things. If you're not confident of those answers, work with your existing provider to help you with that, or we can be a resource for you as well in that. So I know we're running low on time, Wendy. I skipped forward on that, but to save more time for you there.
Okay, great. Thanks, Steve. So I'm going to really quickly do about one sentence each on this so that we can get to a few 1040 tips. This is, you know, the cocktail party talk. Everybody wants to know, Wendy, what are the rates going to do? All right, well, my crystal ball went to milk glass way back in 2010 when they got rid of the estate tax. That was not anything we all saw coming, right? But let me just really quickly, Social Security change. So there is in Biden's proposal, there is a proposal to tax amounts over 400,000 for Social Security. So all of us pay right now up to a 142.8. Then there'd be a gap where you don't pay, and then those over 400,000 would pay. Individual tax rates, top tax rate from 37 to 39.6. Long-term capital gain. This gets a lot of press, but it really impacts fewer people because you have to be in incomes over 1 million. Where I see my client base and the flywheel members being impacted is if you are growing a business like gangbusters and want to sell it. When you sell that business and have a gain in excess of $1 million to be taxed at 39.6% is absolutely insane. So, you know, that is something to be watching if you're considering a business sale. Hopefully that is one that doesn't get through. And then corporate rates going from 21% to 28%. And then a plug for the estate planning attorneys. If you are blessed enough to have an estate worth more than $7 million, which is the amount that Biden wants to move back to, somewhere between $7 million and the current of 23 and a half, then you need to get in touch with your estate planning attorney and start working on that. All right, so a few hot tips for the 1040. Lifetime learning credit phase out. If any of you are doing ongoing education and have tuition deductions, and maybe you're somewhere in that amount right above the old phase out of 118,000 married filing joint, you need to look at that for 2021. They've actually moved that rate considerably higher to 160,000 married filing joint or 80,000 single. For 2020 and 21, you have the ability to take charitable contributions even if you're not an itemized filer. You can take $300 for single or $600 married filing joint. For 2020 and 21, you also have the ability to take your private mortgage insurance as mortgage interest. And then in 2020, we had a record number of refinance with the low mortgage rates. There is the ability to take any points that you paid in that mortgage as mortgage interest deduction if you happen to be an itemized filer. It's a small amount, but we don't want to leave anything on the table. So I think we've wrapped up with maybe 2 minutes to go. So I don't know, Christy, if we'll get to questions, but if I'm happy to stick around for a few minutes if somebody has questions. I don't know what your usual plan is, but I can absolutely stay and answer a few questions, or I'm happy to email people if they have questions that come out of this.
Yeah, that was great. Very informative. I am not a business owner, but I'm sure it was very informative for everyone else. I learned some words and learned some things myself. But yeah, if people need to go, feel free to get off. But if you have a specific question, you are welcome to stay. And also, just to remind everyone, this video will be sent out through email and posted on our Facebook. So if you need to leave and want to catch the end of it, you can catch it later. But yeah, if anyone has any questions, feel free to ask away.
So I'll jump in with one. Thanks again, Wendy and Steve. That was really informative. And as I mentioned, I'm a solo practitioner, a consultant, and I was wondering, are the expenses for my monthly Cobra health insurance premiums, are those fully deductible?
Yes, as a self-employed individual, you can take your health insurance deductions, and that includes COBRA. That also includes for any individual who happens to get to Medicare age and is still running a business, they can take their Medicare premiums as their self-employed health insurance deduction. The caveat is that you cannot be eligible for an employer health plan through yourself or through your spouse. So if you were eligible to participate in an employer health plan, you can't take those amounts as self-employed health insurance deduction.
Which one? That's only the Medicare or even?
No, that's on anything.
Interesting. Okay. All right. Thank you.
Not a problem.
And so, Wendy, that applies to whether if it's you and your spouse, if either of you have a potential corporate plan. Is that right? That's
correct. And what we see most of the time is that one spouse has their own business and the other spouse is employed. If the spouse that's employed has the ability to add the self-employed spouse to their plan, then you actually cannot take a deduction for self-employed health insurance. If the one spouse is not employed at all and the other is a self-employed individual, you can take health insurance for both spouses. You can take both Medicare as a self-employed health insurance deduction.
Okay, thank you.
Mm-hmm.
Anyone else?
I got a quick question. As somebody kind of at the very beginning stages of opening a physical retail shop, what would you suggest? You know, we're trying to find a balance between managing finances on our own and using our CPA where needed. Can you talk a little bit about what a typical client does on their own and what they ask your firm to do, and how can we as business owners make it quick and easy for the CPA and keep our costs down?
Yeah, absolutely. So that is a great question, by the way, because there are a lot of new businesses, sole proprietors, small businesses that think, okay, I'm going to save the money by doing my QuickBooks myself. But what often will end up happening is because you aren't familiar with the software or don't know how things should be coded, that you end up delivering to your CPA something that they basically have to go through line by line and reclass. And you end up paying as much, if not more, to have them do that kind of cleanup before filing a tax return. So I think there are some basic businesses that could probably, almost in an Excel spreadsheet, keep track of their balance sheet and their expenses if they're a consulting type business. With retail, with inventory, I would say that might be a little bit more than you want to take on yourself. The great thing is that either CLA or there are lots of companies that provide very affordable bookkeeping, outsourced controller, outsourced CFO, all of those types of services, that what you may find is your highest and best use is promoting your new business and growing it, and not necessarily trying to get the debits and credits into the right column.
Great, thank you.
Mm-hmm.
And I'll put this CLA sales hat on for a second, Adrian. There, that's where our biz ops team, and I'm speaking on CLA's standpoint, but others certainly. It's a flexible opportunity there, flexible service. So it's not an all or nothing kinds of things there. So talk with our biz ops team and say, hey, this is my situation. What makes sense for you to take over? What makes sense for us to keep doing, those kinds of things. So it's very flexible. And as Wendy says, it helps you, do what you're great at, and then offload the stuff that's not cost effective, not, worth the time, so you can grow the business, and then find that right balance for you.
Great, thank you.
Great. Well, thank you all for showing up today, and thank you again to Joy, Steve, and Wendy for presenting, and we hope to see you guys at the next Jumpstart in April. I will send this out and believe I can send some information on CLA, including their website and everything. So in case you have further questions or want to set up a time to speak with them individually, we highly encourage you to do that.
Thanks so much, Christy.
Yes,
Thank you.
Christy. Thank you, Andrew, if you're still out there. We really appreciate it. And especially to Wendy and Steve, really appreciate you joining us today.
No, I love the questions. I'm excited,
Indeed.
happy to talk about tax anytime. I'm nerdy like that. Have a great day, everybody.
Great. Everyone enjoy your day.
Thank you, everybody.
Thanks. Bye-bye.
Bye.